Hello and welcome to this edition of Money's Best Friend with me, Vivek Law. Stock markets continue to remain turbulent and are witnessing huge volatility. Over the past few weeks, we have been trying to allay fears of investors and guiding them on how to ride out the storm. Today on Money's Best Friend, we take more queries from viewers on how to go about their financial planning. Should investors be scared of this month's stock market volatility? To discuss this, joining me is Suresh Sadagopan, founder, Ladder 7 Financial Advisories and a well-known certified financial planner. Thanks very much, Suresh, for coming by on the show. There has been a lot of worry and concern, isn't it? Because the year hasn't started off well at all for the stock markets. But the good news is that we continue to see retail investors, as we call them, individuals, continuing to open new folios, continue with their SIPs. What are you telling your clients at this point of time?
Yeah, it's very heartening to see that retail investors are not panicking this time and they are not taking the money out of equity markets like it has happened in the past. So what we are telling our investors and our clients is that when we do a financial plan, we are actually looking at what goals are coming up in the short, medium term and long term. And based on their risk appetite and based on what they need to do to achieve these goals is how we put together a portfolio. So there may be a certain amount in equity, there may be a certain amount in debt. So there is a certain asset allocation that we suggest. And even within equity, there may be a certain amount of large cap funds or mid cap funds or balance funds or debt funds. All those things we will have in the portfolio. Equity portion also will have those allocations. So unless, of course, there is a dramatic fall in the market, which I would not call this current correction as a dramatic fall, I don't see any reason even for a tactical reallocation. If people are uncomfortable, some of them can look at a tactical reallocation. Like for example, mid caps have kind of peaked and they may want to reallocate to large caps because that has slightly more potential to perform going forward. But that is not what we are suggesting to investors. We are suggesting investors who have done the portfolio allocation properly, asset allocation properly, to simply stay put, stay with the investment, continue doing whatever has been planned for, and look ahead. The markets will stabilize over a period of time. It is anybody's guess whether it will be 3 months, 6 months or 1 year. So we are not really trying to predict that market. Keep the SIPs on, keep the investments on, and over a period of time, all these things will work in your favor. That's what we are telling.
Right. Suresh, you used the word reallocation or tactical reallocation, as you called it. Another way of putting it is rebalancing the portfolio. All of you advise the basic premise of a good financial plan being an asset allocation driven plan. Clearly, with the equity value in the portfolio, irrespective of whether you've gone through the mutual fund route or the direct equity route, would have fallen, isn't it? Do you think this is the time to do a rebalancing, and could you share some of your thoughts in terms of what this rebalancing would and should entail?
Yeah. So when we actually put an asset allocation in place, let us take an example. Suppose for a particular person, the asset allocation is let us say 60% in equity and 40% in debt. So like at a point like this, when the markets have gone down by almost 20%, the equity allocation in the portfolio will go down. So if we want to correct that allocation to the 60-40% which we wanted to have in the first place, we do what is called a rebalancing. So we will bring an amount from maybe debt or any other asset classes into equity, so that we want to keep it at 60-40 levels. So that is essentially rebalancing. And within that asset class, this is what I was talking slightly earlier, within that asset class, which is equity, suppose somebody wants to invest in large cap fund or a thematic fund or a mid cap fund or some other fund, and within that if you want to slightly rejig the portfolio, that is called the tactical allocation. So tactical allocation can be between asset classes, like between equity and debt, or it can be intra-asset also, like it can be from large cap to mid cap to thematic. So those kind of things can also happen. Largely what we are suggesting is do not really shuffle the portfolio too much at this point in time, because going forward we really don't know what is exactly going to happen, and a lot of times when we do these things, we actually found out that for portfolios where we have not done anything, those portfolios have done much better than the other portfolios where we have done a lot of reallocation.
All right, let's take some of our viewers' queries. Siddharth from Pondicherry joining me on the line. Hi, Siddharth.
Hello, sir. Good afternoon.
Hi, it's nice talking to you, Siddharth. You are in a very lovely city and you seem to be doing very well with your money.
Yeah, thank you, sir. Thank you.
Okay, what's your specific question for us today?
Yes, sir. No, just I want to read. Sir, I'm 41 years old. My daughter is 9 years old. Basically, I'm trying to build corpus for my daughter's education and marriage. And I also want to build a house somewhere around 70 to 80 lakhs.
Right.
So for that, right now, I have 5 mutual funds there going on. And I'm paying 14,000 per month for those.
Okay.
And so I just wanted you to have a relook at those funds, whether they are okay or not.
Right.
And the second part of my question is, I want to invest another 10 to 12,000 in mutual funds.
Okay.
So I would like you to suggest some 5 or 6 good performing funds.
Look, first of all, I can tell you before I toss your question to Suresh, you don't need 10, 15 different mutual fund schemes. All right, Siddharth?
Okay.
It's excellent that you want to invest for the long term. You have a clear goal in mind, which is very important, and you have that already. Your daughter is 9. You're looking at, as you've mentioned, a minimum of a 10-year time frame. So you're perfect as far as that is concerned. Do you need 10 different schemes? No, you don't. But I'll toss this question to Suresh. Suresh, it's wonderful, when you and I talk about getting a goal in place. He's so clear in his mind of why he wants to invest. He has a time frame in mind. But I think, would you agree that to go out there and keep on topping up on as many mutual fund schemes as possible is not necessarily the right way? You've had a look at his portfolio of his schemes. Do you believe they are by and large all right? Or would you suggest some dramatic change? What would your advice be to him?
Yeah, the portfolio which he currently has, the 5 funds which he currently has is by and large all right. There is nothing wrong with that. But the 10,000 rupees, 12,000 rupees which he wants to invest over and above that can be actually done in the same set of schemes. I would suggest a large cap bias and a balanced fund bias in the portfolio. So he can actually top it up in the existing schemes. Now, when we are talking about the education goal, that is probably about 9-10 years away, 8-9 years away. And as far as the home goal is concerned, if it is also going to be about that kind of a time frame, then we actually have a long-term horizon for this. So he's about 20 plus thousand is what he can potentially invest today, and hopefully that is going to go up over a period of time. So I mean, the current portfolio that he has is probably the right one. In fact, if you ask me, I would say maybe 3 or 4 would be the right number, not even 5. Because from the diversification point of view, it's not true that if you have a very large number of schemes, the diversification is excellent, and if you have maybe 3-4 schemes, the diversification is not going to be appropriate. So I would suggest maybe 3-4 schemes, maybe the 5 schemes which you are investing is perfectly fine. But I would suggest don't go too much beyond that. Keep the investment on, top up the investment as and when you have lump sum amounts, because the amounts that you're talking about is actually huge. You are looking at 70-80 lakhs for a house, and you're probably looking at maybe 15-20 lakhs or maybe more than that for your daughter in today's terms. So going forward, that amount will top maybe 1.5 crores or 2 crores over a 10-year time frame. So we are talking about very, very huge numbers. So keep the SIP on. As and when your income goes up, please increase the SIP. When the SIP amount goes beyond a particular level, let us say 30-35,000, you may want to bring in maybe 1 more scheme or 2 more schemes. But don't do that right now. So keep the investment on. Don't worry too much about the market. Keep it on for the long term. So that's my advice for you at this point. You're doing well. That much I can tell you.
We have an email now coming in from Ganesan. He's from Chennai and he writes, I am planning to invest 5,000 rupees every month through equity shares for more than 10 years. Is this the right time to invest in equities, or should I wait for some more time? Well, a classic question and a classic mistake, isn't it, Suresh, which people end up making. Yeah. We are not sure whether he's equipped to invest directly in equities in terms of time or in terms of understanding. Secondly, trying to time the market. That is where we make, he's got his time frame right. 10 years is what he's talking about. But with that time frame, I know equity shares is not something directly that you would advise, but what would your larger advice to him be?
As far as equities are concerned, see, I'm not against equity per se, but the point is you have to have a proper advisor, a good dependable advisor who can invest you on equities. A lot of people actually do this mistake that if they choose an Infosys or an ITC or say an ONGC, I mean the top of the line companies in the market, they are doing well. But the point is we know that some of the even top of the line companies like Reliance have not given great returns in the past 5, 6, 7 years. It can happen to any company in the market today. So if your portfolio is comprised of companies like Reliance, which has not given great returns in the market, so your portfolio may not even average that of a middling mutual fund scheme. So for most people, mutual funds are the investment instrument of choice. Because there is a fund manager, the fund manager is an expert. The only job that the fund manager has along with his equity team is to go through the companies, analyze the companies, and make appropriate changes over a period of time. So I would suggest to Mr. Ganesan to look at mutual funds in a serious way. Whatever kind of funds he is more comfortable with, if he wants a large cap orientation or a mid cap orientation, he should select that. He is talking only about 5,000 rupees, so he can select probably a couple of mutual funds and keep investing in that. Over a period of time, he can re-evaluate whether he wants to continue in that mutual fund. He can stop certain mutual funds at a future point in time, and he can bring in other mutual fund schemes to bring in diversification in the portfolio. As far as the timing is concerned, I mean, we all know that timing the market is not really going to take anybody anywhere. When the market is low, the typical psyche of the investor is not to invest. That is not what Mr. Ganesan says. So the good point is that he is willing to invest at this point also, and that is the right thing. So we don't want to time the market. Continue the investment, keep the investments on for a 10-year period, and you are expected to reap a good reward for your efforts.
Hello.
Yes, Devesh, how are you?
I'm fine, thank you.
Yes, what's your question?
My question was regarding the sovereign gold bond scheme.
Right.
I recently invested in the sovereign gold bond scheme, buying 4 bonds for 5,200 each. The price of gold was fixed at 2,600 a gram by the government.
Right.
So my question is, if the price of the bond appreciates, if the price of gold appreciates, so how do I cash in on the gold bond? Given that there is a lock-in period of 5 years at least, I guess.
Okay. Just wanted to understand, Devesh, when you bought this product, did you not ask these questions to whoever sold it to you?
See, there is no clarity. I mean, I read the circular regarding this given by the government of India and circulated in the public sector banks.
Right.
The publication material gives the answer that it could be traded as stocks or bonds, I guess.
Okay. All right.
But I don't have a demat account.
Okay.
So how do I trade it?
All right. Okay, Suresh, an interesting question there. This, of course, was a scheme which the government wanted us all to invest in. He has done that. He wants to know how he can exit. Is there any route available?
Yeah, let me go to the fundamental principle as far as probably why he has invested in this. Probably he has invested in this because he wants to have an exposure to gold. And he has bought only 4 gold bonds. So we are not really talking about a big investment here. But yeah, I mean, the point he is asking is whether there is an exit option. Yes, there is an exit option if it is because it's a trade. It is going to be a tradable instrument. It will be listed on the stock exchange, and he can exit on the stock exchange. So that is the answer to his query. But the larger question is the amount involved is very small, and if he really wanted to have a position in gold, I would say that he should keep that invested, because we are talking about a few thousand rupees here. We are not talking about lakhs or crores of rupees here. So I would largely suggest that he not even think about listing and selling at a future point in time from the point of view of returns, and rather allow it to be in the portfolio from the diversification point of view.
And if it does get listed, he would need a demat account, Suresh. What would be the logistics of being able to trade if he chooses to ignore your advice and still wants to sell it?
Yeah, a demat account will be required. So it will be existing in the electronic form, and he could possibly sell it at a future point in time, but that is not what I advise. So a demat account will be required.
Okay. All right, here's an email that is coming in from Avijit Mitra from Bangalore. He writes, I'm 29 years old, married, drawing a salary of 60,000 rupees per month in a central government job. I already have a PPF since 2010 and have also taken an insurance policy. This year onwards, I want to get into mutual funds. I can invest 15,000 rupees per month in mutual funds. I don't have any existing EMI. Where should I invest to get a minimum corpus of 30 lakh rupees in the next 20 years and 15 lakh rupees in the next 10 years? Please suggest.
Yeah, I mean, it's very, very heartening to know that a 29-year-old is talking about planning and building a portfolio at this point in time. So there are some very, very clear thoughts from him. So congratulations for that. As far as mutual funds are concerned, considering his age is only 29, he can actually look at it from the long-term point of view. So predominantly it can be an equity portfolio. So if his objective is to build a 30 lakh portfolio in 20 years, assuming a 10% return, he just has to invest something like 4,000 rupees per month. And if we assume a 12% return, he just has to invest something like 3,000 rupees per month. So those are the numbers. So I think what he could potentially do will be far, far higher than that. And looking at the 15 lakh investment, 15 lakh portfolio which he wants to have in about 10 years, he may have to invest something like 7,300, roughly 7,300 at 10% and about 6,500 at around 12% investment returns. So I don't know why he is currently talking about these numbers, 30 lakh and 15 lakh. Those numbers seem to be just hypothetical numbers. But largely what I would say is he should put together a portfolio as per his asset allocation requirements. I would say that, I mean, he's at the start of his career, start of probably building a portfolio. He should approach a proper financial advisor to do that for him. But very broadly, I would say that considering his situation, there are bound to be certain short-term requirements, short-term goals, so for which he will have to build a corpus predominantly in debt funds. But as far as his long-term portfolio is concerned, he can potentially look at maybe 65 to 70% in equity and balance in debt. As far as the equity component of the portfolio is concerned, he can look at predominantly a large cap portfolio and with mid cap bias. When I say large cap portfolio with a mid cap bias, I am saying something like 40% in large and mid cap kind of funds, and 30% probably in mid cap oriented, mid cap heavy kind of funds. That is what I would suggest. But largely things would depend on his propensity to take risk. So it's better that at the start of his career he can take advantage of a qualified financial advisor. That's what I would suggest.
All right, one final question coming in for you, Suresh. This is from Dr. Preet from Mumbai, and she writes, I'm 32 years old and from the past 4 years I've been investing 7,000 rupees per month in different mutual funds. My query is, should I continue investing in mutual funds or should I change my portfolio? I'm looking for an investment horizon of 20 years. Please suggest. Well, Suresh, a classic case of getting worried and therefore questioning the very basis of whether one should remain invested in a mutual fund. What's your advice to her?
Yeah, I mean, considering that Dr. Preet is only 32 years old, I mean, she has a very long-term career ahead. So long-term horizon for earning. Say it is probably 25 years from now that she may consider retirement. So considering that, when we have such a long-term horizon, mutual fund will definitely be an investment of choice. So probably she is having second thoughts about mutual fund, maybe because of the market levels or maybe because of the turbulence that she is seeing in the market today. But there is no case of terminating the mutual fund investment at this time, because it is going to only hurt her. Mutual fund investment, if we look at from the long-term history, of course, future cannot be predicted from the past, but it gives an indication. So there are a lot of good mutual funds which have given 20% plus over a long period of time. So even if we assume just a 10 to 12% return, and that is, we have to understand that is going to be post-tax. So that is going to actually stand her in very good stead over a long period of time. So a simple suggestion is that she should keep invested in mutual funds. If she wants to diversify her portfolio into other things, she could, but not at the cost of mutual funds.
All right, Suresh, thank you very much, like always, for coming by and sharing your perspective with our viewers here on Money's Best Friend. Thank you. It's
Thank you
time
very
now
much.
to wrap up this edition of the show. If you have any queries related to equity, mutual funds, insurance, real estate, gold, then do write into us at moneysbestfriend@archtak.com. Have a lovely weekend.